Welcome to vSkills YouTube channel. In this video, you will learn about the top interview questions for financial valuation. So, let's get started. Question number 1. What is the importance of financial valuation? The answer is: the higher is the financial valuation, the easier it becomes to borrow money, the higher the per share price and the higher is the price in the case of an acquisition. Question number 2. What is paydown and how do you calculate it? The answer is: debt paydown is the process of decreasing the amount owed on a mortgage or other loan over time by making partial payments towards the debt. And it can be calculated as the principal portion of a monthly loan payment divided by the original principal of the loan. Question number 3. What is a deferred tax? The answer is: a deferred tax is the tax that is assessed or is due for the current period but isn't paid yet, implying that it will eventually come due. Question number 4. What are the different types of shares? The answer is: the different types of shares are preference shares. This type of share gives certain preferential rights as compared to other types of share. Equity shares. This type of share is traded actively in the secondary or stock market. These shareholders have voting rights in the company meetings. Differential voting right, DVR, shares. The DVR shareholders have less voting rights compared to equity shareholders. Question number 5. What is free cash flow to the firm? The answer is: free cash flow to the firm is primarily used in DCF financial modeling, such that a company generates cash flows from its operations by selling goods or services, such that some amount of its cash goes back into the business to renew fixed assets and for the working capital requirement. In layman terms, free cash flow to the firm is the excess cash generated over and above these expenses. It goes to the debt holders and the equity holders. Question number 6. What are the 3 most used methodologies of valuation? The answer is: the 3 most used methodologies of valuation are: first, discounted cash flow analysis; second, comparable company analysis; third, precedent transactions. Question number 7. What do you understand by precedent transactional analysis? The answer is: the precedent transactional analysis is a valuation method that takes the past transactions of similar companies to value a company. We use the following steps to conduct precedent transactional analysis. Similar companies are chosen based on their features or work industry. We compare the size of the transactions as it should be similar. We compare the type of transaction and the features of buyers as they should be the same. Then the transactions that happened more recently have been considered more valuable. We estimate on the basis of the above factors. Question number 8. What is a debt schedule? The answer is: a debt schedule is basically the list of debts obtained by the organization and consists of debts such as debentures, bonds, term loans and leases. Question number 9. Describe asset and liability management. The answer is: asset and liability management refers to the management of financial risks arising due to mismatches between the assets and liabilities as part of an investment strategy in financial accounting. Question number 10. What does the term budgeting mean? The answer is: budgeting finds its use to set up, create, and view budgets. Budgeting includes budget control, which one can use so as to monitor the budget funds available for planned and actual purchases and expenditures. Additionally, one can generate budget register entries for the original budget, budget transfers, and revisions. One can also create budget register entries for encumbrances and pre-encumbrances for purchases and planned expenditures. Moreover, budget register entries are automatically generated when budgets are transferred to the general ledger from other modules, like project management and accounting or fixed assets. Question number 11. Why would 2 companies merge? The answer is: there are many reasons for companies to merge. These include achieving synergies, entering new markets, gaining new technology, eliminating a competitor, and also as it's accretive to financial metrics. Question number 12. What is debt financing? The answer is: in this method, a company raises funds in the form of a loan which comes with an interest portion. So, the company would have a monthly obligation to repay it. The benefit of debt financing is that in this form there is no control of the lender in the business, and at the time of full repayment, the company and lender's relationship ends. Question number 13. What is an income statement? The answer is: an income statement is also known as a profit and loss account. This is one of the major types of financial statements of the company which shows the revenue, expenses, and net profit or loss of the company at a specific period of time. Question number 14. What is the composite cost of capital? The answer is: the weighted average cost of capital shows the composite cost of capital. Parameters such as the debt, preferred stock and common stock are reflected in the eventualities of the composite cost of capital. Question number 15. What is a balance sheet? The answer is: a balance sheet is basically the summary of the financial situation of a business which represents the actual position of assets, cash, liabilities or bank balance at a specific period of time. Question number 16. What does negative working capital mean? The answer is: negative working capital is common in industries like grocery retail and the restaurant business. For a grocery store, customers pay up front, inventory moves relatively quickly, but suppliers usually give 30 days credit. Hence, the company receives cash from customers before it needs the cash to pay suppliers. Question number 17. What do you understand by the term debentures? The answer is: a debenture is a certificate of loan agreement furnished under the stamp of a company. The debenture holder is mandated to receive a fixed return as well as the principal amount at the time of the maturity of the debenture. Question number 18. What are the basic concepts of finance? The answer is: the three main concepts are: first, financial management; second, financial markets; third, institutions and investment. Question number 19. What are some ways to design a revenue schedule? The answer is: some of the common ways are: sales growth, unit volume, change in volume, average price and change in price, inflationary and volume or mix effects, dollar market size and growth, volume capacity, capacity utilization and average price, unit market size and growth, product availability and pricing. Question number 20. What is equity financing? The answer is: in this method, the company can raise comparatively more amount of funding than debt financing. The financier would get some of the ownership of the company and offer funds as per the working capital requirement. Moreover, there is no monthly obligation of repayment of funds and no interest portion is to be added to the principal amount. Question number 21. What is DCF? The answer is: DCF stands for discounted cash flow. This is the best valuation technique for calculating the value of the firm at the time of acquisition or financing. In DCF, the net present value is calculated for future cash flows. Question number 22. What does EV stands for? The answer is: EV stands for enterprise value. This is a measure of the total value of a company, often used as a more comprehensive alternative to equity market capitalization. Question number 23. What do you mean by WACC? The answer is: WACC, that is the weighted average cost of capital, is the calculation of a firm's cost of capital wherein each category of capital is proportionately weighted. Question number 24. What do you mean by precedent transaction analysis? The answer is: precedent transaction analysis is a type of valuation method in which the price paid for similar companies in the past is considered to be an indicator of an organization's value. This analysis creates an estimate of what a share of stock would be worth in the case of an acquisition. Question number 25. What is terminal value? The answer is: terminal value is the value of an asset, a business, or a project beyond the forecasted period when the future cash flows can be estimated. Question number 26. What is UFCF? The answer is: UFCF stands for unlevered free cash flow, that is the amount of available cash that a firm has before accounting for its financial obligations. Question number 27. What is accelerated depreciation? The answer is: accelerated depreciation is a method by which a company, for financial accounting or tax purposes, depreciates a fixed asset in a way that the amount of depreciation taken each year is higher during the early years of an asset's life. Question number 28. What is calendarization? The answer is: calendarization is inclusive of spreading the recognition of a transaction over more than one reporting period. Question number 29. What do you understand by the term beta? The answer is: beta measures the volatility or systematic risk of a security or portfolio compared to the market as a whole. Question number 30. What is book value? The answer is: book value is equal to the cost of carrying an asset on a company's balance sheet, and firms calculate it netting the asset against its accumulated depreciation. For more such videos, subscribe to our channel.